Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have John Cole-Scott, President and Chief Investment Officer of CEF Advisors and CEFdata.com, Mike Taggart, ClosedEnd Fund Specialist at Abrdn, and Dave Dziekanski, CEO and Chief Investment Officer of Quantify Funds. And we're here to discuss what makes closed-end funds unique. Gentlemen, it's great to have you with us as always. Welcome to Trade Talks. John, welcome back to you. And let's kick it off with a high-level overview of what CEFs are and where they fit in an investor portfolio.
Absolutely. The U.S. market has just under 500 listed closed-end funds, and it's been trading in the U.S. since 1893. The U.S. market really is about a third equity funds, a third tax-free muni, and a third taxable funds. And really, retail investors are the primary owners. There are a handful of firms like ours, Closed-End Fund Advisors, that's been doing this for 35 years. And I've been doing it for about 23 on the tail end of my father's 50 years. And they're often yield focused, and they're a great way to access active management with a stable share count base. And for funds where appropriate, there's often prudent and tactical leverage to enhance shareholder investment return.
Mike, what type of investor are closed-end funds appropriate for?
Oh boy, I mean, you have a whole slew of investors. Most closed-end funds were designed to provide income for investors in one way, shape, or form. So you see a lot of investors who are seeking income who invest in closed-end funds. They're not for everybody, obviously, because most, in order to provide that higher distribution than other vehicles, a lot of closed-end funds also use leverage. And so that leverage kind of exacerbates volatility. And so the risk profile can be a little bit higher than say like an unleveraged mutual fund, that sort of thing.
Mm-hmm. So David, let's talk about that some more then. What makes closed-end funds unique?
I think they're fixed pool of capital, right? It allows for a reach to more illiquid securities. Traditionally, closed-end funds, each series every couple of years launches an asset class that's not yet liquid enough for a 40 Act product in a traditional sense, but is available through a closed-end fund product. And there's a lot of innovations on that side. I look at it as a very good fit in exchange for high yield or private credit in a client's portfolio in a world where everything is expensive and bid up, finding things at discount. Beyond just the income potential, the alpha opportunity because of these discounts, if managed correctly, can be very, very huge. So both for an income distribution phase as well as a potential source of alpha in an overall portfolio.
Right. And John, tell us more about these discounts. And what about the recent shift to munis by the institutional world? How is this evolving the environment?
Yeah, so current discounts ended the quarter roughly a 6 and mid change, which puts it in par with longer term averages, except for you go back 20, 25 years, they're still very attractive by over 2% for the entire universe. And again, discounts tend to narrow and widen based on both market activities. So I think interest rates raising or lowering, as well as sentiment of investors wanting to be excited in a fund or sector, or maybe a manager or platform that's very well known. And again, munis, they're down to only having wider month-end data in the last 25 years, 10% of the time. But had we spoke 6 months ago, it was 1% of the time. And so that area, because it's so retail owned and because interest rates rising were real, really impacted the NAV of those funds and the distribution ability of those funds, because especially in munis that were long dated investments and shorter dated leverage generally, it was hard for the excess yield to be passed through to shareholders when short-term costs spiked about 2.5 years ago.
Right. So Mark, it sounds as if the macro environment does have some sort of an impact onto CEF. So tell us more about that.
Yeah. So like John was saying, and Dave alluded to, discounts just over a market cycle tend to widen and narrow, right? Depending on largely investor sentiment, what's going on, and that kind of the spread between the leverage cost and what, the carry trade there. So right now, I think what we're seeing, especially in the last, let's say, month, and we saw it earlier this year, is investors are anticipating, a Fed rate cut. And when we start to see Fed rate cuts, what we should see across the board, especially in munis, is discounts start to narrow across the board. That's typically been what we've seen during market cycles. Now, there will obviously be some sectors then that will be out of favor. Their discounts will naturally widen in that part of the cycle and so forth. But we are starting to see discounts narrow because of investors' sentiment and investor excitement about potential upcoming Fed rate cuts.
Mm-hmm.
And again, I'll just add real quick that it's
Okay.
interesting in a closed-end fund world with so many different sector exposures, you often have part of your portfolio doing well while other parts do poorly from a total return perspective while clipping the different yields. And what we do actively at CF Advisors, in fact, in the last 3 years, for some clients, 9 rounds of tax loss selling, and there's so many sisters, cousins, neighbors that allow you to rotate the structure for tax asset harvesting, yet not lose asset allocation or cash flow generation that we find beautiful for our clients.
David, would you consider this an alternative investment in a way?
It has inherently some equity and credit and interest rate exposure. Some of that can be hedged out, but done appropriately, it does have the profile of an alternative investment. I'll add to what Mike and John said in that it's kind of amazing that the discounts per category can move independently of each other. There's so much potential value there. And our research has shown that the discounts widen the most on poor performance of the asset class, right? So it's almost like a mean reversion's dream where right when an asset class underperforms the most, the retail owners of that fund are most fed up with it. They sell it. People tend to sell their losers and not their winners. And discounts explode to sometimes historical levels. And that's what we're seeing in the muni space right now. And it's not just municipal bonds. It's really traditional. It's really everything that's tied to duration, right? Anything that had interest rate sensitivity over the last 4 or 5 years, you can see what treasuries have done. That exposure alone has destroyed the price return of the NAVs alone and widened out the discount on anything that's tied to interest rates.
Right. So, John, does that come down to portfolio construction then?
It does. I mean, we build taxable portfolios for clients and qualified accounts, and we use people's estimated tax friction, like the marginal tax rate, to build tax friction at the client level. And we're always looking to find, discount direction that's a tailwind versus a headwind, dividend sustainability or durability, that's a tailwind, not a headwind, and then logical and reasonable asset allocation for the clients. And people always say closed-end funds have been dying for most of my career. There's about 8 non-merger deaths a year, and we're on pace this year with 4. And I think there's been a lapse in IPOs, but that's meant more of a push to focus on the current products in the market, accessing all of that data to make those decisive decisions for clients.
Jill, I'll also add, if you look at some of the issues occurring with non-traded REITs, there is the world where there's further and further adoption of the closed-end fund structure for illiquid assets, just because a lot of people are tied up in illiquid real estate investments that they thought they could have some liquidity on that they might not be able to get over 33 basis points a month of their funds out for the foreseeable future. And that illiquidity premium is just terrible, and it should be priced at a discount. I wonder what discount, some of these closed-end REITs would be if they actually were in a closed-end fund structure. It'd be quite substantial.
Yeah. Well, somebody had noted here that managing a closed-end fund portfolio is more similar to blackjack than you may think. What's the rationale behind that? What does that mean?
Well, yeah, we're writing an article about that right now. And a professional blackjack player will try to count cards and figure out what the true count is on the deck and bet accordingly. And when the cards are in his favor and the true count is high, they will increase their bet size. And it's the same thing on a closed-end fund portfolio. You just have to increase your net exposure or work with some hedges if discounts are low. There's always opportunity. At discounts, you're collecting outsized income on your assets. And so you're basically selling insurance, right? That discount is just like a form of insurance sales while you wait. And then you have to have the ability to increase your bet size if things explode, if volatility increases, if discounts widen. And that's very similar to the structure of how you would position bets in a blackjack game.
Right. And Mark, where does recent fund activism come into this conversation?
Fund activists are, investors, shareholders, just like every other shareholder. Obviously, some are more aggressive than others, but everybody at the end of the day, look, we all want to make money for our investors, right? So most activists, they want to come in and make sure that there's underlying NAV performance and that's being reflected in the share price, meaning that the discounts stay narrow, right? We want to do that too, right? We want our shareholders to understand that, or to reap the benefits of the NAV performance by keeping the discounts narrow. That doesn't always happen because of what we talked about before, just natural things that happen in the market with investor sentiment, et cetera, et cetera. So, I think one of the things that we've been trying to do and other fund sponsors is trying to raise the distributions higher. There's been other corporate actions that firms have been taking to try to enhance, shareholder returns to make the price kind of respond. But again, you're also fighting sometimes against that investor sentiment. If investor sentiment is against the sector, that in any kind of corporate action, it's really hard to offset that investor sentiment.
Got it. And Mike, my
Yes.
apologies. I called you Mark in error. Thank you for picking that
That's
up for
okay.
me. And I said the first initial, right? And John, anything else that you'd like to include in terms of what investors need to be aware of if they're considering a closed-end fund?
Yeah, I'll just add to the activism piece. There's almost $10 billion of pretty active, focused investors, about 4 or 5 that count in that space. And when a fund might do a tender offer, which basically you get maybe a 15 discount, 2 cents off of NAV, so 13% return. And people say that's a positive thing. We always oversubscribe tenders for clients. We think everyone should generally do that. The next day, we usually buy back all the shares because we like the fund. It's just mathematical tailwind. But the monthly distributions are noticeably higher than a year and 3 years ago. And those are basically less expensive, better tenders. Though the risk, I'd say, is make sure you don't spend every dollar collected because the long-term cash flow may not be sustainable for 100 years. And I've been doing this a long time. It's a blend of fundamental analysis, quantitative analysis, which David focuses on heavily, and doing manager due diligence, because there's lots of phenomenal managers that are known and some that are not known that you can analyze with all of the layers of the 40 Act for daily NAVs, for investor transparency, way more than in unregistered funds.
Right. And if you want to consider a closed-end fund for your portfolio, would you get in touch with your advisor? Are they more readily available on
It is. So, there's firms like us that focus on it. We're not the only ones. There's also analysts at the major wirehouses, which have active research on it. There's people that discuss it in various places. Many financial advisors that have a larger book of businesses use closed-end funds on average, 10 to 20%. We're 95%, because that's what we do. It's what our name is. And my dad was, heavily involved. So definitely it's worth talking to your advisor, but not all advisors have been educated as well as they could have. So we at our firm and our partners try to create a lot more content to make it easier to make those investment decisions for the clients you serve.
Right. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.